All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Monday, everybody. Today is December 30th, 2024. I hope you all had a wonderful weekend as we enter the last two trading days of 2024. And it looks like we are going to wrap up this year full of all-time highs. It's been a pretty amazing year for stocks, seemingly making a new high day in and day out, but we're going to end the year on a very low note. Stocks are down again this morning on essentially no really big news. There's no big bankruptcy. Nobody's blowing up right now. Stocks are down 1% and change across the board. The Dow's down almost 500 points at one point this morning ahead of the opening bell. So we've got this low volume selling into year end, a lot of profit taking. I'd say tax loss harvesting, but I don't think there's really all that many losses to harvest at this point because pretty much everything is up, although most of those gains are concentrated among just a few names. So maybe there is a little bit more tax loss harvesting going on than we realize because of the narrow breadth of this market, all the gains being just in those Mag 7 names. But it's been a rough couple of days for stocks here. This year-end correction is continuing this morning. Also going on this morning, we have got a big surge in the price of natural gas going on here. Now, when we say natural gas prices, the most frequently quoted number is the Henry Hub price. That's the U.S. natural gas price. And I do think a lot of this is being driven by U.S. weather. We have a big cold spell is coming up here in the eastern U.S. They're predicting single digits, yay, winter coming up, possibly a large blizzard going to hit the Northeast in the next couple of weeks. So whenever you're seeing a big move in natural gas futures, it's almost always the weather that is the primary driver, although there's some other geopolitical things going on in natural gas as well. When you got cold weather heading for Europe, also next week, unseasonably cold. They're expecting single-digit temperatures in most of the major European cities. Now, the other big story going on in natural gas this morning is we're just 2 days away from the expiration of this Russia-Ukraine gas transit deal. Now, most Russian gas flows to Europe have already gone quiet, but there has been I don't want to say a token amount. There's been a non-zero, a significant amount of natural gas is still flowing through Ukraine into Eastern European countries. Countries like Slovakia, Moldova, Romania still get a lot of their natural gas from Russia. And there's this deal where the Ukrainians pretty much allow Russian gas to flow through pipelines in their country to their European allies. That is going away. That deal expires midnight on the 31st, tomorrow. And the two sides aren't even talking right now about an extension. So this deal has been kind of humming along for the last couple of years since the invasion. There's been these last-minute deals every time to extend them a little bit. Maybe that happens again this time around. Maybe they cut a deal at, right before midnight and yay, all is saved. The countdown goes to 1 second and then the timer stops, just like in a Star Trek episode. Or maybe this time they finally screw things up enough where the gas gets shut off in the middle of winter. And Europe's actually not having a mild winter anymore. It's been mild pretty much right up until last week. Now things are just starting to get cold. And, look, I need I remind you guys of European energy policy. We're watching the German government collapse in real time because their energy policy has been pretty much dictated by imbecilic children for the last 20 years. And lo and behold, there are consequences to that. So Europe may have trouble keeping the heat going. Their natural gas inventories at about 75% full. That's not an alarming level so long as winter remains mild. I just got done saying winter's probably not going to remain mild. We have cold weather on the way. So natural gas futures way up this morning, being driven by all those stories combined. We had more issues with airplanes over the weekend. You guys may have noticed there's a lot of videos going around on Twitter and other social media. There was another big plane, a deadly plane crash. Jeju Airlines lost a plane over the weekend in South Korea. Between that and that plane that was shot down last week by Russian air defenses, and then it ended up crashing in Kazakhstan, I believe is where it crashed. Those two accidents at the end of the year have now made this the deadliest year for air travel since 2018. So it was otherwise a pretty good year for air travel, believe it or not. I mean, we had so many stories about Boeing all year, like wheels falling off, the Alaskan Air, that panel that blew out. It seemed like a very dangerous year for air travel. But statistically and by fatality count, up until last week, it was actually a very good year for air travel. Well, that is no longer the case, thanks to the Russians and now this South Korean story. Now, South Korea has ordered an inspection of all 737-800 planes in their fleet. Now, there's no indicator right now that this is anything to do with the 737-800. Boeing stock way down this morning on this news. It was down over 4% at one point. The last I checked, it was 2% and change in the red. Now, there was some stories about possibly bird strike being involved, so we don't know what caused this crash just yet. But when it comes to 737s, Boeing investors sell first, ask questions later. So we got that going on. We also got a story about credit card delinquencies. This one was in the Financial Times this morning. Credit card loan defaults are at a 14-year high. They're up 50% year over year, a big surge in delinquencies. And they mentioned that for the most affluent, for the richest among us, things are just fine. But for the bottom 1/3 of consumers, the savings rate is now effectively zero. And we're not talking about the bottom 1%, the bottom 5%. The bottom 1/3 of consumers has nothing left in the bank. Now, I know, like they've been saying, hey, people have predicted 59 of the last 3 recessions and that whole thing, and like denying that it's a recession and the soft landing. But when 1/3 of consumers have nothing, what do you call that if not a recession? I don't care what GDP is technically doing because the government is spending so much money to make the economy look artificially strong. 1 in 3 people has no money left at all. That's a recession, folks. Any way you look at it, that's a recession. We also got a deal this morning to save Big Lots, or at least save some of Big Lots. We reported last week that Big Lots was unable to reach a deal, and they were closing all 900 of their remaining stores. Well, we found out over the weekend that they reached a last-minute deal to keep some stores alive. I'm seeing numbers anywhere from 200 to 400, so somewhere maybe a quarter to half of the remaining Big Lots stores may remain in operation. We don't know how many employees are going to be saved. There was some non-committal language in the article about this deal, but at the very least, we're going to avoid a worst-case scenario where all the stores close and everybody loses their jobs. We also got a story, one to keep an eye on, Home Street Bank. Now, Home Street Bank is one of those commercial real estate banks with a lot of exposure in that sector, and we've been keeping an eye on them for a while here. I haven't mentioned them by name on the channel, but they've been on my short list of banks to keep an eye on. They cut a deal over the weekend with Bank of America. They're selling a nearly $1 billion multifamily loan portfolio to Bank of America, and they're only getting $900 million for it. So Bank of America is getting a pretty sweet deal. Home Street is taking a pretty big haircut on this. They're going to lose about $90 million on a $990 million portfolio, 10% loss. But interesting detail, they're trying to close this deal before the end of the year. Got to cram that sale in so it hits the books before the end of the quarter so you can report a better looking balance sheet at the end of the year. Keep an eye on Home Street Bank, guys. That's one to watch. I'm not going to say in any imminent risk of failure or blowing up or anything, but this is a bank with a lot of exposure to commercial real estate, and they're taking a haircut to reduce that exposure. So that is a name worth keeping an eye on. And there's a crazy story out of Colorado over the weekend. Apparently, Colorado's unemployment data has now become so unreliable and so questionable that the government is not going to use it anymore. The Bureau of Labor Statistics is saying, we don't like your numbers. We're just not going to use it. Now, I don't know if the number is unreliable in that it's acting like there's more jobs and fewer people unemployed than there really is, or is it saying that there's more people unemployed and more jobs than there really is? They don't say which direction the error is in, just that they have no confidence in the data, and so they're not going to use it. And so, I mean, I don't know how do you do this? How do you calculate the unemployment rate and jobs numbers for 50 states when Colorado, which is a pretty big state, there's a lot of electoral votes in Colorado. Oh, we don't like that one. We're just not going to count it anymore. Guys, that data is so important. And, it's one of the things, the inflation data and the jobs data, I've been saying, it's just too important. There's too much riding on this to allow the bureaucrats and the politicians to fudge the numbers. I hope that's not what's going on. They're blaming an IT upgrade, of course, kind of like a crypto exchange that goes down during periods of volatility. It's always the IT guys that screw it up, right? Isn't that usually what happens? Certainly nothing nefarious going on, I hope, over in Colorado. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in markets. Hey, don't forget that like button and that big, beautiful subscribe button right next to it so you can come have your coffee with the melon heads because we do this one every morning. Right now, the S&P 500 is down 66 points, 1.11% lower. It's been a rough morning for stocks. Guys, I went through the economic data. There was really no one story out there in the market that I can point to and say, aha, this is why the market is down 1% across the board. This is a very broad year-end selling. Santa skipped over our house for Christmas is what that means. No Santa Claus rally. The market gets coal in its stocking. Insert whatever coal analogy or pun you want to make. In this case, we've got the Dow is also down here, 411 points, 0.96% lower. At one point, the Dow was down nearly 500 points. Looks like, could we even catch that a bounce? We're slightly off the lows pre-market here. But things not looking so good ahead of the open. And the NASDAQ is worse than all of them, down 1.33% here, 285 points in the red ahead of the open. We are selling off across the board here. Meanwhile, we've got a dollar starting to strengthen. Wow, this came out of nowhere in just the last couple of minutes, all of this green shoots in the Dixie here. We actually had a dollar that was in the red most of the morning. And now all of a sudden in the last couple of minutes, a severe strengthening in the dollar. Somebody must have opened up here. 108.25, up 25 basis points or 0.23% higher for the dollar. So that's going to add to the downward pressure on your asset prices this morning. And we've got lower yields here. Now, remember, guys, yields and prices inversely correlated. So yields lower means prices higher for most of the bond market this morning. A little bit of a flight to safety going on. Emphasis on a little bit. It's not a very big move. We got the 30-year Treasury, 4.765. That's down 4.5 points. The 10-year, 4.557, down 6 points and change. That's a decent move for the 10-year this morning. The 2 years at 4.269, down almost 6 points. And the 1 month is relatively unchanged at 4.321. Looking over at the commodities board, we got a little bit of red here. And this is why I said it was emphasis on a little bit of a flight to safety because gold and silver are not participating here. Spot gold, $2,613. That's down about $6 and change here, 0.25%. Spot silver, meanwhile, at $29.26. That's down a dime or 0.35% lower. We've got copper down 0.5%. Platinum is down 0.2%. Palladium is down about 0.25%. But oil is in the green this morning. We got 71.25 for February WTI futures. That's up about 65 cents, almost 1% higher this morning. Let's take a look at Bitcoin here, down about $800 as priced on Coinbase, $92,726. No big Bitcoin news this morning. This little bit of a sell-off we've had at year-end. This correction is continuing here. We hit a high of 108,000 on December 17th. Now we're down pretty substantially from that level here, although obviously Bitcoin's still way up for the year. Now let's talk about some of these natural gas stories. This is the biggest one in the market today. I don't think this is what's driving this big sell-off in stocks, but this is probably the biggest piece of news here is what's going on in gas prices. Natural gas, cold weather forecast lifts prices despite bearish inventory report. I'd add that inventory report's a couple days old. That came out on Friday. Well, we've got natural gas prices rise on colder weather outlook despite the bearish storage report. February natural gas futures posted gains Friday, driven by forecasts for colder weather in January. However, upside momentum was limited by a bearish government storage report. Forecaster Maxar Technologies indicated that below normal temperatures are expected to affect the central and eastern U.S. between January 1st and 5th, with further intensification in the subsequent 5 days. The prospect of increased heating demand helped lift natural gas prices. Now, guys, I would add, since Friday, since this article was written, they've had another run of those models. In particular, the European model here in the U.S. shows a monster blizzard could hit the U.S. Northeast believe in the first week of January here. So we got some severe cold and possibly a whole bunch of snow coming for the Northeast. That typically means higher gas prices. Now, I'm sure the speculators are taking this one a little bit far. That's usually what they do. They overreact to a forecast. The prices surge up. Subsequent forecasts come back down to earth and bring prices with them. But we've got several other stories affecting gas this morning. Europe braces for winter's coldest snap with gas stores in focus. This one is in Bloomberg, dated just this morning. Temperatures across Europe are forecast to plunge at the end of the week as areas of low pressure move through the region. London, Paris, and Berlin will see average temperatures below zero on Friday and Saturday, Weather Service's international data show. I believe they're saying below zero. Guys, remember, this is Europe. I don't know if we're talking Fahrenheit or Celsius. Makes a big difference here. Either way, we're going below freezing here in London, Paris, and Berlin. Let's see, 6 degrees below the 30-year normal. The UK Met Office has expected some snow in the coming days with extreme winds and rains also forecast. Across Germany, too, forecaster DWD has issued warnings for frost and ice. The coldest spell so far this winter is likely to push up heating demand, tapping into gas reserves that have fallen below 75%. Withdrawals from inventories have already been faster than usual this year. That, coupled with the impending end of the Ukraine-Russia gas transit agreement, has sent European natural gas prices near highs seen earlier this month. Now, let's talk a little bit about that story they just mentioned there. Ukraine and Russia's gas transit deal is at a critical moment of truth. The deal allowing Russian gas to transit to the EU ends on December 31st, and Slovakia is stepping up pressure for flows to continue. The future of gas transit through Ukraine is at a turning point. If a last-minute deal isn't struck by Wednesday, billions of cubic meters in gas flows could come to a halt. Ukraine is under mounting pressure from Slovak Prime Minister Robert Fico and a group of Central European companies to keep gas moving from its eastern border with Russia into the European Union following the expiration of a transit agreement on December 31st. Almost 3 years after the full-scale Russian invasion of Ukraine, Budapest and Bratislava still rely on cheap gas from Gazprom, undermining the EU's push to cut reliance on Russian energy. With 3 days to go before the Russia-Ukraine agreement runs out, rhetoric on all sides has sharpened. Ukraine's President Volodymyr Zelensky earlier this week accused Fico of striking shadow agreements with Russian President Vladimir Putin. The Slovak leader on Friday threatened to halt power supplies to his eastern neighbor, a step Ukraine criticized. To diplomats with knowledge of the talks, the escalation hasn't come as a surprise. Past disputes over gas transit between the two former partners saw flows cut or reduced at short notice and deals clinched at the very last minute. So maybe they cut another last-minute deal here, maybe not. Also, guys, we've got this one, and this is unrelated to this gas transit deal. This is a separate agreement here. Russia's Gazprom says it will halt gas supplies to Moldova starting on January 1st. So we've got another fight over natural gas brewing here. Russia's state-owned energy giant Gazprom said Saturday it will halt gas supplies to Moldova starting on January 1st, citing alleged unpaid debt by the European Union candidate country, which has brought in emergency measures as it braces for power cuts. So Europe's energy crisis may be laid bare here, guys, between the cold that's approaching, this expiring gas transit deal that affects pretty much the whole eastern half of the continent, this other deal with Moldova, combined with cold weather expected in the United States, and we end up with a chart that looks like this. This is daily candles of natural gas futures, the Henry Hub prices. Look, guys, big spike here. Now, prices were way down on Friday. You see this little dip, but now we are right back up to where we were after that because of this big move. Natural gas prices are up 17.88% this morning, trading at $3.99 per, that's per million BTUs. It's a thermal equivalent unit. But just look at the run-up we've seen in natural gas prices since September here. Pretty substantial move we've had in just these last couple of months. Now, if we zoom way out on this chart, let's go back a couple of years. Now, you can see where we're at here. Obviously, prices nowhere near the highs that we saw in 2022 off of the Ukrainian invasion story. But this is the highest that we've seen since, well, let's say January of 2023, December of 2022. So other than the initial post-invasion hysteria, this is the highest natural gas in the States has been in almost 2 years. So we'll pay attention to this one. We'll see if this is just weather related or are we going to get another big move if this deal expires. Now let's shift gears a little bit to what's going on in the skies. 2 plane crashes lead to the deadliest year in the sky since 2018. Onboard deaths in 2024 jumped to 318 after recent crashes. I've heard that number is as high as 330 now. Commercial aviation has suffered its deadliest year since 2018 after the Jeju air disaster in South Korea and last week's downing of an Azerbaijan Airlines plane. Onboard passenger plane fatalities this year jumped to 318 with the 2 recent crashes. Data compiled by Cirium shows that's by far the highest death toll since more than 500 people died in 2018, a year marked by the first of 2 Boeing 737 MAX crashes. The year started and ended with tragedies in Japan and South Korea during attempted landings. Among the most dangerous phases of flight, fatal aviation accidents remain very rare, and one major incident can suddenly turn a statistically safe year into one of the worst. Now, here's the actual accident in question. Jeju Airlines crash. Boeing falls 4% in pre-market as South Korea orders Boeing 737-800 inspections. Boeing shares dropped nearly 5% in pre-market trading Monday after South Korea ordered an inspection of all Boeing 737-800 planes, the model involved in a deadly Jeju Air crash over the weekend, operated by its domestic carriers. Acting President Choi Sang-muk told the Transport Ministry to carry out an emergency safety inspection of the country's entire airline operations system, while officials at the Ministry of Land Infrastructure and Transport, or MOLIT, said they would conduct a comprehensive special inspection of the Boeing 737-800. Now, guys, I just want to add there's no indication of any cause here yet. There was some mention of the fact that bird strike may have played a role. The plane or the airport had put out a bird strike warning moments ahead of this crash. So I don't know if that's what happened here or not. There is video of the crash. The plane tries to land on its belly, and unfortunately, it just doesn't go well for anybody on board. Right now, Boeing stock is down almost 4% on this news. Again, no indication yet that this is Boeing's fault. I think this is just people who are a little hypersensitive to any headlines involving Boeing. And can you blame them after the year the company has had? But right now, Boeing shares trading at $173.99, down about 3.75% ahead of the opening bell. Let's get a little more into the macro data this morning. Credit card defaults surged to a 14-year high. It's the best economy ever, and the consumer is strong and resilient, right? Maybe not so much. Credit card defaults are at their highest level since 2010 as consumers feel increasingly stretched. As the Financial Times reported on Sunday, card lenders wrote off $46 billion in seriously delinquent loans in the first 9 months of this year. That is a 50% jump over 2023. 50% increase in 1 year of credit card defaults. That's the highest level in 14 years, the report said, citing industry data compiled by Bank Reg Data. These write-offs, the report notes, happen when lenders conclude that it's unlikely a borrower will repay their debts and are considered a measure of major loan distress. High-income households are fine, but the bottom third of U.S. consumers are tapped out, said Mark Zandi, the head of Moody's Analytics. Their savings rate is now zero. The whole bottom third of the country, their savings rate is zero. That means they can absorb no financial difficulty without going deeper into debt. That is a recession, guys. That's people who are not taking vacations, who are not going out to eat. 1/3 of the country. That's huge. Financial Times points out that this steep increase in defaults indicates the financial pressures facing consumers after years of elevated inflation and higher borrowing costs. While banks still haven't released fourth quarter earnings, the report adds there are early signs that more consumers are falling behind. For example, Capital One said recently that its annualized credit card write-off rate, the percentage of its overall loans considered unrecoverable, hit 6.1%, up from 5.2% a year ago. Now, while we're talking about this, let's talk about, because they mentioned banks there, let's talk about this one. This isn't credit card data, but this is similar data here. Home Street to sell $990 million in loans to Bank of America. And these are multi-family loans, apartment building loans. The Seattle-based parent company of Home Street Bank agreed to sell $990 million in multifamily commercial real estate loans to Bank of America. The price, including the value of retained servicing, is 92% of the principal balance of the loans, and the loan sale is expected to close before Tuesday, December 31st. You got to squeeze that in before the end of the year, right? That closure date of Tuesday, that smacks of desperation by Home Street. The pricing of the loan sale reflects the current interest rate environment and that the loans being sold are primarily lower yielding loans with longer duration than the overall portfolio, said Mark Mason, chairman of the board and president and CEO of Home Street, in the release. The proceeds from the sale will be used to pay down Federal Home Loan Bank advances, or FHLB advances, and brokered deposits, which carry substantially higher interest rates than our core deposits. Now, that's important there. Federal Home Loan Banks, That's like an emergency source of liquidity for banks, and broker deposits is when they go to other banks that are less troubled and they actually buy money from those banks. They buy their deposits and pay a higher interest rate for it. So what's happening here is Home Street is bleeding out cash. They're paying out more money than they're earning in interest, especially on these long duration loans for multifamily portfolios. So they're losing money. And so they're trying to clean up their books, make their balance sheet look better just in time for the end of the quarter and the end of the year. Home Street has been pressured for some time by paying more for deposits while earning less on its investments. Bloomberg reported on Friday. The bank reported a net loss of $7.28 million in the third quarter, its fourth consecutive quarter in which it had reported losses. So Home Street Bank is losing money. They're trying to cut off some of that bleeding. They're going to take one big hit selling off this loan book at a big discount to Bank of America. Bank of America is going to get even bigger. Now, Home Street stock doesn't really seem to care this morning. It's down about 0.2%. It's actually way outperforming the rest of the market. So I would interpret this as the market likes this move by Home Street here. But this is one to keep an eye on. And, this bank hasn't really moved much year to date. If we look at a 5-year trend on this one, though, this bank took a bath in 2022 and 2023. It really doesn't like these higher interest rates. This is one of those big commercial real estate banks. They've got a lot of exposure to multifamily loans, and they're trying to reduce that exposure now. Now we've got some good news, a silver lining this morning. Big Lots strikes a deal to save stores and stop brands from closing. Again, a little bit of a silver lining. It's not an outright bailout here. Bankrupt Big Lots Inc. has struck a deal to save hundreds of stores after an earlier sale of the business fell apart, saving the chain from closing down entirely. The company said Friday it has agreed to a transaction with Gordon Brothers Retail Partners that will facilitate the transfer of Big Lots brand, stores, and distribution centers to other operators. The proposed transaction would avert the potential closing of all Big Lots locations after an earlier deal to sell the business to Nexus Capital Management unraveled earlier this month. Big Lots said that Variety Wholesalers, Inc., which operates several discount chains in the Southeast and Mid-Atlantic region, intends to acquire between 200 and 400 locations as part of the transaction, the company said. Variety Wholesalers intends to keep operating stores under the Big Lots name and may employ Big Lots associates at the acquired stores and distribution centers, as well as certain corporate associates needed to support the go-forward footprint, the retailer said. So the story last week was that Big Lots was going to sell permanently shut down all 900 remaining stores. It looks like they finally cut this deal, and somewhere between 200 and 400 locations are going to stay open here out of those 900. So still we're going to get hundreds of store closures. And I would just add that they're saying they may employ certain Big Lots associates and certain corporate employees. So they might lay everybody off. They might not. It's not exactly job security, but at the end of the day, guys, Big Lots is better off than they were last week when they were just basically looking at shutting the whole thing down. So at least a partial stay of execution for some of the Big Lots name here. Now let's talk about this one. Now, guys, I have been harping on the accuracy of government data for quite a while now, and this story really jumped out at me. Shout out to my moderator, Mish, who caught this one this morning. Unreliable Colorado job stats lead federal agency to pause their use. The state blames the irregularities on a new technological system that led to decreased employer reporting rates. I really don't know what to make of this story other than, gosh, our government sucks at everything they do. The state of Colorado's unemployment numbers are so unreliable that the federal government says it can't even use them anymore. The United States Bureau of Labor Statistics issued a notice on December 18th saying it was suspending the publication of Colorado's employment and unemployment data. The quarterly census of employment and wages first suspended using Colorado data on November 20th. That data is also used in the calculation of local area unemployment stats, which led to the suspension of unemployment data in December. The Colorado Department of Labor and Employment said the error is the result of an attempt to modernize an old system for employer reporting. Employer reported data dropped to just 28% in the third quarter of 2023. The state said that figure had bounced back to 80.4%, but the Fed stopped using the data regardless. Now, guys, I really don't know what to make out of this. It doesn't say, did the data move in one direction or the other? And I don't know which federal data points this is going to affect. Is this going to affect the unemployment report? I don't know. It's actually the Census Bureau. that puts out the unemployment numbers at the end of every year. So I don't know if it's going to affect the actual unemployment number. Maybe it affects the JOLTS, the job openings and labor turnover survey. I'm sure it affects the monthly non-farm payrolls report, the jobs report, which is arguably the single most important statistic in finance right now. But the fact that a state like Colorado, right, we're not talking about Hawaii or one of those like 2 electoral vote states. This is a pretty populous state. This is a pretty big deal here. And the numbers have become so unreliable that the government's just throwing it out. And, it sure be nice to know what the actual state of the economy is. Instead of these empty platitudes we've been getting for years about strong and resilient and everything is just fine and ignore what the doomers are telling you. Well, apparently it's not so strong and resilient, because the data you're basing that strong and resilient talking point on me, you just told me, is garbage. And so, once again, to all the journalists who have been on vacation for the last 4 years, welcome back to the world of journalism. Welcome back to asking questions, to scrutinizing these data points. It's good to have you guys with us again. Maybe now that we have people who actually ask questions, we can find out what the state of the economy really is. And real quick one, guys, here. New law requiring businesses to report who owns them is put on hold again. There's a lot of guys out there with side hustles that are doing this under an LLC. You guys are probably aware of this. The beneficial ownership interest form, the requirement from the Corporate Transparency Act, it was suspended by a court case, and then the court got rid of the suspension, and then they put the suspension back on. So as of this moment, right now, you don't have to report it, or at least you won't get fined and penalized if you don't report it while this deal is worked out in court. Look, they say this is an anti-money laundering thing. Like all these other reports, we're really going to go after the people that are hiding their billions of dollars in shell companies. At the end of the day, are they really going to get any of those people? Probably not. We already found out in the Panama Papers what they were doing, and none of them got prosecuted. But we are going to go after the people who are making a few $100 on Etsy's selling knitted beer koozies. Can't have them laundering money through their Etsy side hustle. So yeah, let's give them an extra form to fill out every year just to make life that much more miserable, thanks to our government. Gotta love your tax dollars at work. Hey, while we're at it, maybe fix those Colorado unemployment numbers. And I just want to say thank you so much to Mr. Bart Stapleton. Thank you, Bart, for supporting the channel. He says, Jack, please explain the bond market crisis to me like I'm a 5-year-old. All right. I wouldn't call the bond market in a crisis right now. All right. The bond market has been like on the edge of a crisis for quite a while. Explain like I'm a 5-year-old. The government borrows so much money, they've got to borrow it from somebody. All right. Now, typically, the government has borrowed money from other countries, China, Japan, Europe. Right. Right now, other countries are not borrowing as much money, or are not lending as much money to the United States as they used to. So who else does the government borrow money from? The government borrows money from us in our retirements, our 401ks. Also, the government borrows money from banks. Banks take our money that we loan to them and put it in there, and they buy bonds with it. So they hopefully earn more interest on the bonds than they pay us in interest. All right. Now, what happens theoretically when the government runs out of people to borrow from? The government borrows so much money that there's no money left to borrow in the world. Well, what happens when, take supply and demand, for example, when there is more demand than there is supply, what happens to price? Price shoots up. It goes higher. And what is the price of money? The price of money is interest rates. So that's what you would call one of those black swan liquidity events. They call it a liquidity event. What it means is there is not enough money to satisfy the demand for money. And so people start outbidding each other to borrow what's out there, and it sends interest rates high. And when you're a society that is hopelessly dependent on debt, you can't afford higher interest rates. It causes bankruptcies and defaults and a deflationary debt spiral. So historically, what happens every time we get into one of these bond market crises is the Federal Reserve steps in, and they call them liquidity restoring operations, or they'll say we need to ensure healthy functioning of our financial system or market stability operations. They come up with all these cockamamie phrases for printing money into existence in order to increase the supply of money. And then they take that and they lend it to the government. They monetize the debt. That causes inflation. So hopefully that explains, hopefully the 5-year-olds among you were able to follow that. Now, I just want to add, we're not in a bond market crisis right now at this moment, but we are seeing consistently higher interest rates. All right. Since the Fed started cutting rates, interest rates have actually started moving higher because the Fed doesn't control the 10-year, the 20-year, and the 30-year. So I do believe, Bart, eventually we will be in another bond market crisis. And you could argue things like a surging dollar with the Dixie at 108, the 10-year yield moving sharply higher despite a Fed easing cycle. You could argue that these are indicators that there is a bond market crisis on the horizon. And you won't get much argument from me. It's a matter of time. It's when, not if, that happens. Thank you, Bart, for supporting the channel, sir. I appreciate that very much. Mighty Mike 53 says reverse repo 268 spike up with a question mark. Remember, Mike, we got that end of the year, the end of the quarter, and the end of the month. All right. You typically, if you stretch out on the reverse repo chart, go look at what happened at the end of last year at this time. Big spike, several $100 billion in quarter end. And then as soon as the new year was behind us, we saw it come right back down even lower. I have every reason to believe that it's going to play out exactly that way. I think we're going to see an even bigger spike tomorrow and the day after. Probably see it go as high as 300, maybe even 400 billion. And then we are going to slam right back down. That is year-end transactions. It messes with the whole repo market. I couldn't explain the specific mechanics of it to you, just to say it happens every quarter end. And typically the year-end quarters are even bigger spikes. So expect that to get better. And then it's going to come back and resume its trajectory toward zero. Thank you, Mighty Mike, for everything you do for the channel. Armando Reyes, what's going on, brother? He says, Maryland is in trouble. Bring on the fall. We need a global correction. Wonder why Maryland, Armando? I wonder what's going on. Anything specific to Maryland, or are we just talking about generally the whole state of everything? I haven't heard anything Maryland specific recently. Let me know in the comments or shoot me an email if there's something that makes you pick out that state, or are we just talking about your home state there? But that's interesting. I have not heard much about Maryland specifically. Thank you, Armando, for supporting the channel. Hunt and Cover says, thanks for your hard work, or your work again, Jack. Hunt and Cover, it is my pleasure, sir. Thank you for supporting the channel, for being a Melonhead member for 10 months, a seasoned veteran Melonhead. Thank you so much, Hunt and Cover. I appreciate that very much. M&J, my blue wrench. Thank you so much, M&J, for everything you do for the channel. She's triggering Mish with the all caps there. And she says, thank you to all the Melonheads who have been awesome this year. May your 2025 be amazing and blessed. Love you guys. Now hit that subscribe button. I love the good vibes to end the year. Thank you so much, M&J. I appreciate everything you have done for the channel this year, last year, and in the future. You are awesome. Thank you so much. And thank you to all those Melonheads. And hey, yeah, a reminder, hit that subscribe button. Why not? Why not hit that subscribe button while we got all these good vibes going? Thanks again, MNJ. Armando says, get out there and buy as much silver as you can. Your life may depend on it. It's the end of the world as we know it. All right, maybe that got a little excessively doomerism, but I can tell you I like the shiny. I got my Murica 10-ounce silver bar that I keep here because I just like to flash it. I just like the way it feels. I like the shiny, guys. Look, you never really spend any money on silver. You just park your wealth there. You spend money on premiums and you spend money on shipping. So make sure you shop around and don't waste too much money on those premiums and on those shippings. But yeah, I like the shiny. Good vibes, Armando. Thank you very much, sir, for supporting the channel. Appreciate that very much. And thank you, everybody, for having your coffee with the Melonheads this morning. Oh, Zeeble Fritz jumping in there. He says, happy market crash Monday. Not sure if it's a crash, but you never know. Maybe we get that 1,000-point down spontaneous live stream today. Stranger things have happened. Thank you very much, my Patreon supporters, for everything you guys do for the channel. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.